Fresh off of that vote over at the SEC today, approving rules that will effectively allow thousands of stocks and ETFs traded on exchanges to be quoted in half-penny increments. Explain why this is a good thing.
This is a good thing for everyday investors because the narrower what's called the bid-ask spread, that half penny in the future, which is now a minimum of a penny, that's less that you as an investor, everyday investor, have to pay to the market for liquidity to do your transactions. And economists have said this for a long time. We put a restriction into the market in 2005 that you couldn't quote in less than a penny. I think that was outdated. We relaxed that and moved it to a half a penny. Good for investors, good for capital formation in America.
As the SEC, you guys have a tool that helps you see, who's trading the markets. It's called the Consolidated Audit Trail. There's been some pushback on that and some lawsuits that could really put its existence in jeopardy. Do you guys have a backup plan to see kind of how then you have transparency in the markets? How do you see who would be in the market?
Alex, it's really important to the markets that the stock exchanges, the other self-regulatory organizations, and the SEC be able to guard against manipulation in the market and other bad action like jumping ahead or using quotes from folks to spoof the market and so forth. And so for a long time, for decades, we've had certain transparency. This consolidated audit trail would be more efficient. It was put in place starting in 2012, if I recall. And you're right, there's some lawsuits around that. I'm not going to comment on that. We always do things according to the law and how courts interpret it. But the key really is to help the stock exchanges, the self-regulatory organizations, the SEC guard against manipulation, insider trading, and other, bad things in the market, and that boosts trust in the market.
Do you feel, Gary, that investors today are better protected than what they were in the past, particularly given that we're having this conversation on the anniversary of the week of the collapse of Lehman Brothers, AIG, and of course you being brought in back in 2009, a year after all of this, at the CFTC at least, to kind of help clean all this up here? When you look at where we stand right now, how does it compare to then?
But I think a lot's changed since 2008 and 9. Markets are much more electronic, much more algorithmic trading, much more even use of artificial intelligence in the markets. Commission levels have come down. Another thing is the everyday investors, the retail public, is more engaged in the market, more participation in the market. But it doesn't mean that a gold medalist, and I think we are kind of the U.S. capital markets, this $55 trillion stock market is the best in the world. But it doesn't mean you still have to kind of punch and trade, basically train to do better. That's why we shortened the settlement cycle earlier this year. All investors will know this. You sell your stock on a Monday, you get your cash on a Tuesday. You don't have to wait till Wednesday any longer. These reforms that we did today, I think, are consequential reforms to lower the cost of the market.
I am curious about rules going forward, particularly as we move from a market that I think was a little bit more subject to human infallibility. And now we're sort of moving to an era where you mentioned the algorithms. Of course, artificial intelligence is being deployed at a lot of these firms now. And we don't have, not yet, any sort of clear set of rules as to how to manage the risk that bringing more automation into this market brings.
Well, we've been automating for a long time. I mean, I'm told that well over 100 years ago, there were debates on whether to let telephones on the floor of the New York Stock Exchange. So automation is a good thing overall, but you're absolutely right. We have to also make sure that we still protect the investing public. In terms of artificial intelligence, I think it can bring greater access and promote markets, but at the same time, we have to guard against fraud, and fraud is fraud. And whether you're using an algorithm to defraud the market or your human is doing it, it's against the rules. I do think that there's a challenge that the financial crisis of the future might be that we say, oh my gosh, we were all relying on the same model, the same algorithm, the same data. That's a challenge that is on this guy's mind.